Okay guys, good morning. Wednesday 22nd of November, and we are in historic times. We will be covering the further all-time ever highs made by a lot of these global stock indices, but particularly the US markets yesterday continuing their relentless march north. So we'll talk about that. We're going to talk about oil, which had a nice break to the upside yesterday and is approaching its 2.5-year high. We're going to then have a little look into this thing that's kind of getting a little bit more traction in the press, and this is the flattening of the US yield curve. And in fact, it's the flattest it's been for 10 years now. And what does that mean about the outlook for markets and economies as we head into 2018? And then we'll have a little roundup of what's been going on and have a look at the day ahead. So yeah, let's start with equities, and I present to you the weekly chart of the S&P 500, which is a good place to start when you're trying to really, let me just actually tidy this up. I'm just going to delete everything off this chart. When you're trying to explain to somebody, just how remarkable the US equity rally is, then this chart right here is probably the best place to start, where we're looking back over the last, well, pretty much 48 months, where we've moved from the lows at the beginning of 2016 and down at 1800, and here we are a full 800 points to the upside. It's like a 45% rally here, and it's just the sustainability of it, it's the relentless nature of it, and we have again extended on all-time highs. This is not new for 2017, of course. If I go to a daily chart and just go back to, let's look at the whole. If you look at the whole of, I'm just going to look at the last few months. So this is going back to the summer, and in the summer, at the end of it, let's say start of September, we broke above the August high, and then we marched higher. And ever since then, I mean, more often than not, I haven't actually done the precise maths here, but it looks, roughly speaking, as more often than not, every day since, we've had a new all-time high. There's been more days where we've had new all-time highs than we have not had new all-time highs, and this thing marches north. So yesterday we broke the November the 9th high, and indeed for a very brief moment edged and ticked above 2,600. So 2,600.50 is the latest all-time high. We pull back a little bit, and as you can see, the range today so far is nicely defined by yesterday's high and this low and the high from the 9th of November. So we're kind of trapped in this this little range here, technical range here. So bear in mind that it wasn't just the S&P, of course. Here's the Nasdaq. The Nasdaq yesterday broke above its November high, the earlier November high, to make another all-time landmark. The Dow Jones smashed up through its 6th of November high to mark the highest level it's ever traded. You had other markets in the mix here as well. I mean, let me show you. This is a chart of Bloomberg's MSCI Asia Pacific Index, and here we broke actually above the 2007 peak to make a new all-time high. You might have been reading a bit about the Hang Seng overnight, because the Hang Seng, here's the chart, broke through 30,000. This is the Hong Kong Stock Index, broke above 30,000 overnight. That's actually not an all-time high though. This is actually breaking above the key resistance set back in, what was that, like May 2015. So we kind of smashed up through there. We broke 2,900, as you can see here, and immediately shot up to break above 30,000. Sorry, 29,000, shooting up to 30,000. But if I actually step back,
spot gold has a bit of a move higher.
Yeah, well, gold's just moving higher. We'll talk about that in a second. But if I just if I go back, you'll see that actually the Hang Seng Index was higher than this, only for about a couple of weeks back at the in October 2007. That was just before the financial crisis took hold. So actually above 30,000, we have been above that before, and we actually went up and tested 32,000 back in 2007. So bear in mind that. So look, most of these indexes, if they're not making all-time highs, then they're certainly making multi-year highs. Here's a couple of things I showed the guys during the session yesterday, but you might have missed it. Here's a look at the relentless nature of this rally with regards to the lack of pullbacks that we've seen. So this is only 4 times in history has more time passed without a 5% correction lower in the S&P 500. So I showed some of you this yesterday. We're up at 350 months now. We've gone 350 months without a 5% correction. We have had, as you can see, 4 occasions where we've had longer than that, most recently back in the mid-1990s. Here's a look at the VIX. So this is again related to the S&P 500, but here we're looking at the sort of the Chicago or the CBOE volatility index. This is looking at the put and call options activity, and we often call this the fear gauge. Essentially this has an inverse correlation to the S&P index. So when the S&P goes up, the VIX goes down, and when we start to panic and when we start to get uncertain about the economic future, and when we start to get worried about equity markets dropping, then you'll often see a pickup in activity in let's say put option purchasing, and this leads to the volatility index rallying. But this thing closed below 10. The VIX closed below 10 again last night, down 1%. And this is as the S&P's trended higher over the last 2 years. You can see here the VIX has trended lower. Let me just get this in perspective, because we can go back here to 2008. Actually, I can go back further than that. Here we go. We can go back to the end of the 1980s here, or the start of 1990. So just to put this in perspective, this is record lows. The VIX, the volatility index has never been lower. Equities have never been higher. You get the story. All right, so we're heading into Thanksgiving this week, and as you can see, you know, investors are fairly nonchalant. They're pretty positive. They're not worried. We've had a couple of developments this week that might have turned people's heads. So we've had the German political risk flaring up, and that's as a result of the coalition talks between the Jamaican coalition talks breaking down. Just a bit of an update on that as I show you the graphic. Hang on, I had a graphic, here it is. You know, what are the potential outcomes from here now that the FDP party have seemingly broken ranks and aren't interested in forming a coalition anymore? So just an update here. I've covered this every day this week already, so there's nothing major to update other than the fact that the German president has been very busy behind the scenes, and there is now talk, the latest kind of rumorings from overnight is actually the SPD party may think about reforming the Grand Coalition. So that's the SPDs with Merkel's CDU, CSU, reforming the coalition that served as the government in the last 4-year term, and there's talk that maybe they might come back to the table and have a think. Back pre-election, which was back in September, of course, the SPD party said, look, we don't want to be the junior member of a coalition anymore. We want to be the main opposition party, so we're not interested in a coalition. That's what they said. But maybe the president has been able to just persuade them that the coalition's the best way forward. Otherwise, the FDPs are certainly still not keen on getting back to the negotiating table, it would seem. And so if the SPD ultimately refuse, we're probably looking at a new election, which will be February or March next year. Okay, so maybe some slight positive developments on that front, but we'll see. We'll keep an ear to the ground. All right, let's get back to the charts. So we've spoken about equities. They're very comfortable, you know, and as it stands, that situation, that kind of sentiment doesn't seem to want to change. Okay, there's nothing really on the schedule that would potentially impact that, you know, pre Thanksgiving. We've got the Senate probably voting on the tax reform bill Monday next week, and so that might then, you know, hot things up a little bit, and maybe we'll get some activity. But in the meantime, this equity space is just grinding higher. Let's talk oil. That's the kind of big move overnight. Oil's had actually a really great sort of couple of days here. This is a 60-minute chart, and you know, bottoming out down below 56 bucks earlier in the week on Monday indeed, and then, you know, stepping higher yesterday, breaking up through the resistance from the day before, topping out up above the 57 handle. Briefly, we pulled back in them. You might remember in yesterday's session we had a nice, clean, quite powerful break up through R1 and Monday's high, some stops getting triggered, a nice propulsion higher, but actually that was the exhaustion point for the upside, and then we dropped back in, and it was the exhaustion point on the upside until we got news flow on US inventory data last night from the API, and let me show you the chart. Hang on, transition my screenshot. These are the figures from last night, and look at the top one, that's the most important. How did the level of crude oil stockpiles change in the US over the last week? And they've reported quite a sizable drawdown, and indeed it was the biggest weekly drawdown since August, and one of the biggest weekly drawdowns, as you can see on this chart, of the whole year. Let me just get the accurate figures. Hang on one second. So the actual crude drawdown itself was minus 6.356 million. So the biggest drawdown since August, and one of the biggest of the whole year. Okay, you had quite a sizable drawdown in Cushing as well, down 1.5 million, and for Cushing likewise one of the biggest drawdowns of the whole year. Marginal build in gasoline and a drawdown in distillate. So quite a bullish report overall, and that's certainly how the market responded as we pushed higher. All right, it didn't get back to the afternoon high straight away. This data is released at 9:30, but we drifted and drifted, and then at the start of the Asian session last night, ping, we broke the high from yesterday afternoon, and then this set in motion a nice trajectory to the upside. If I go to a longer time period chart, you'll see that this has propelled us up to, actually I'm just going to move that line to there, and I'm going to add another line there. Let's say we've gone up and we've tested the $58 handle, which caused some nice resistance back on the 7th. On the 8th of November, we did break that very briefly, and we hit 58.14. So that's the 2.5 year high for crude oil, 58.14, set a couple of weeks back. If I show you on a weekly chart, you'll see, well actually you won't see, I need to go back on a monthly chart, which will bring in the kind of the commodity crisis collapse in 2014-15, but since then, let me adjust a couple of lines here. Since then, the highest we've traded, let me just delete that line. The highest we've traded since then has been the rebound. So I'm trying to remove a line. Been the rebound in May 2015, where we briefly got above 62 bucks. So it's the highest we've been since the kind of spring/summer of 2015 here. So a 2.5 year high for crude, helped along by not only the inventory data last night, but of course as we move to the OPEC meeting next week, comments from or news flow from Russia yesterday is indicating that we are going to get probably at least a 6-month extension to the OPEC production cuts. So oil definitely on the march. Be aware, $58 tested already this morning, but 58.14 is that 2.5 year high. So that's the price to be mindful of on WTI futures. Okay, let's talk yield curves. I know it's your favorite topic. So you're going to get, this is back in the headlines. This is something we've been talking about and mentioning off and on, well, on different occasions through 2017. What this chart here, this is from the FT, and they're reporting here, US yield curve hits its flattest point since November 2007. What you're looking at here is a chart that shows the difference between US 2-year yields and US 30-year Treasury yields. Okay, so we're talking about government bond yields here, and we're almost down to 100 basis points, which is 1%. Okay, so the difference between a 2-year and a 30-year yield is now basically down to 1%. Why? And what does this potentially mean? So why is a tricky one to answer. It's a little bit of a, well, I'll tell you why. Firstly, think about the short end. So why are 2-year yields? Well, they've actually been moving higher, and the 2-year yield in the US is the highest it's been for a few years. And the reason why this is the case is because the Fed are hiking rates, and they're signaling that they're continuing to hike rates, and they're looking to hike rates 3 or 4 times in 2018. They're going to hike rates again in a couple of weeks at their December meeting. Although it was interesting to see Yellen speaking last night, and now that she's stepping down, it does feel like she's returning back to her comfort zone of the uber dove. So she was questioning, or let's just say expressing some concerns about continuing to hike rates last night. She looks like she's breaking ranks, and now that she's no longer going to be president in 2018 at least, looks like she's turning back to her dovish slant. But that aside, markets don't really care about that because she's going. Literally her last meeting is in 3 weeks, so it doesn't really matter what she thinks now, to be brutally honest. But the Fed are hiking, so that's helping to push up and maintain higher 2-year yields. Okay, so what's happening on the long end of the curve at the 10-year or the 30-year end? Well, why aren't those yields going up? And there's perhaps 2 reasons. Number one, people are thinking that the inflationary outlook is again softening. So long end yields go up because of inflation, but if you don't think inflation's going to rise, well, then these yields stay depressed. The other thing to think about is Japanese and European quantitative easing. Both of the Bank of Japan and the ECB QE programs are suppressing long duration bond yields in Japan and in Europe. That's because these central banks are buying longer duration bonds like they're going out of fashion, buying them, boosting price, lowering yield. Okay, but that means then if you're a global investor and you're looking to find yield, on the long end of the yield curve, well, Europe and Japan, it ain't going to be where you find it. So this is forcing more money across the Atlantic into US bond yields, just because on a relative basis those US yields look more attractive. So it's funneling more money into that market, again suppressing these longer duration yields. Okay, so this is why you're getting this flattening. The reason why people are talking about it is because there is a stat that you need to be aware of, and that sounds quite alarming, and that is that every recession since the Second World War has been preceded by an inversion of the US yield curve. So for every single recession we've had, and there's been I think 7 or 8 recessions in the US since the Second World War, maybe even more than that actually, thinking about it, but every time we've had an inversion. Now we're not inverted yet. The 30-year yield is 1% higher than the 2-year yield. An inverted yield curve is when you get the long end yields dropping below the short end. So this might be possible in 2018 because the Fed are going to carry on hiking, or at least that's what they're communicating. So those 2-year yields should get driven higher. But then you've still got the Bank of Japan and the ECB buying bonds as part of their QE program, and inflationary pressures don't yet seem like they're coming through and materializing. So if you do get this Fed continuing to hike, the Fed actually might force an inversion of the yield curve. Now, it's not necessarily the case that if the yield curve inverts, bang, 1 month later the economy collapses and we have a nightmare recession. That's not the case. And in fact, before the financial crisis, the US yield curve was inverted for actually a couple of years. Really dumbfounding Greenspan. Before then, the whole world unraveled and we had a massive, spectacular blow-up. But the yield curve was inverted for a couple of years. So anyway, it's something to be on your radar. Not today. It's not going to shift markets today. It's just a theme that might be gathering a bit more momentum and headline space, let's say, as we track into 2018. Something that the Fed, if the Fed turn more hawkish next year and inflation doesn't rise, then they might have a little bit of a problem with their rate hiking trajectory. So something to be mindful of. Okay, what else? Let's just look at the Bloomberg headlines, because there's someone creeped in onto the homepage of Bloomberg here. I wonder if you can guess who I'm going to talk about by looking at my screenshot. A serious blast from the past. Of course, I'm looking bottom right, and we've got a certain Mr. Silvio Berlusconi looking for a comeback. He's currently fighting in the courts because back in 2013 he got nailed for tax evasion, which was perhaps the least surprising headline in recent decades. But because of his conviction for tax evasion, the rule is that you're not allowed to be Prime Minister if you've been convicted for something. Makes sense, right? Well, he's trying to challenge this in the courts, and he's trying to unleash a comeback, and maybe Berlusconi's going to be running for a 5th term in office when the Italians go to the polls next year, starting next year. So Silvio is back. I have warned you. The last time he was in office, Italian bond yields spiked above 7%, and Italy almost defaulted. That's all I'm going to say. Let's look at the calendar for the day ahead. So the final day before the Thanksgiving shutdown in the US. This does mean we're getting some data that normally would be released on a Thursday in the US being brought forward a day early. But just to talk about Europe first, there's nothing in Europe. I mean, rarely do you ever see this, but there's literally no European data this morning of any note. We've got the UK budget, so Hammond will be stepping up and delivering the budget live in Parliament starting at 12:30. That's certainly important if you're trading things like the pound, obviously. Definitely UK asset sensitive news flow coming at 12:30. Then US data, plenty of it, durable goods, jobless claims, Michigan sentiment, consumer confidence as well. So it's a pretty decent lineup for US data, with then the oil inventory data, and will we get a bullish report from the Department of Energy like we got from the API last night, and will that trigger a break of 58.14 and a new 2.5-year high? We'll see. We then have the minutes from the FOMC meeting from 3 weeks ago released tonight, but we're not expecting too much action from that one. Okay, let's just finish back on the charts just to wrap it up. I've spoken about oil, I've spoken about equities. Just as I've been on the mic, we have had gold just ticking higher. So gold, this is a 2-hour chart here. So we've just broken above yesterday's high, and which is also R1 pivot today. So we've just taken that out. We've just pulled back and found some support around that area. This is really trying to retrace some of that Monday sell-off still. We're about the midpoint of the week's range here, but gold just trying to push higher. The euro's also been nice and positive, which has actually forced the DAX lower, so we'll talk about the DAX in a second. But the euro dollar here has broken above yesterday's high, which is also R1, and again trying to track back some of those losses from Monday's session. So quite similar to what's going on over in the gold market. With the euro pushing higher, this is just adding a little bit of weight to the DAX, and we've dropped below yesterday afternoon's kind of support area and just drifting lower, currently heading down towards the pivot level on the DAX, which is 13,133 on the futures. So just a bit of euro appreciation, tipping the DAX slightly lower. Okay, I think that's it from me actually for now. Remember, no European data this morning, so there's no scheduled news flow, but you might get some, I don't know, more OPEC headlines ahead of the meeting next week. We might get some stuff out of Germany. Be aware that Hammond is speaking and delivering the budget at 12:30, so cable will certainly be influenced by this, or sterling I should say, and I've got this trend line that I drew yesterday on my cable chart, which is now being tested, coincided with the pivot level as well. So we'll see if there's any nervousness or even optimism and positivity going into the 12:30 announcements, but you should get some volatility here as Hammond delivers the budget. Okay, right, that's it for now, guys. Enjoy the session. Thanks a lot.